Debbie. Good afternoon, everybody. As I said, I'm Cheryl. I think some of you have heard me talk before, and we've spoken over the phone many times. I'm that horrible person that sends you all those lovely emails asking for lots of data out of your system on a monthly basis in the year end. And then when I'm not satisfied with all of that, I send you further emails asking for more stuff or saying that things don't agree with the payments that you send them through. So I do apologise for that. I'm actually quite nice, really. I just pester the life out of you, I know I do. So what I'm going to have a look at today is just sort of going back over what we've probably done all ground before, really, is how important the pay is. It's been spoken so many times today, so we'll have a little bit of a look at what has been happening since April 2014, a reminder of those data requirements, those all-important areas, how that transfer of data is now taking place, and a little bit of feedback on how year-end did go this year. So what has been changing? We seem to be in here a lot over the last couple of years, learning about the new scheme, and we bombarded you with information way back in readiness for those 2013 regulations coming into force on the 1st of April 2014. We also then had this year the Pension Regulator Code of Practice, which John talked a little bit about this morning, and how important then scheme record keeping is and how much more governance there is around that. So that's meant a lot of changes for you as employers, a lot more information to provide, and our data is only as good as the information that you send through to us. So again, it's why we keep saying, please, please, you know, this is what we need. So that's just a list really there of some of those key changes from those new scheme regulations that came into force. I'm not going to go through each one individually on this slide. We'll have a little look at a bit more detail as to how that affected payrolls. One of the big things there, picking out halfway down, is assumed pensionable pay, APP. I think my slides will probably win the prize on the amount of acronyms that we're going to be going through. So if there's anything you're not sure of, just shout it up. Also, the 50-50 section was introduced. So again, that was something quite new for us, you know, our scheme providers. So what did this mean for payroll? Panic probably was the first thing when we started. There's a few nods I get from people, so yeah, that was obviously the case. Because payroll systems were set up in a way that then all these changes came along and the systems may not have been able to be, you know, easily extracting that information or able to do those calculations. So you are now having to ensure that your payroll could deduct pension contributions under the new definition of pay, which then included non-contractual overtime and additional hours. So that was something that was new, you never had to do that before. But we were also asking that you're going to have to give us full-time equivalent pensionable pay, so that's the FTE, under the old scheme rules. So you're going to have to start thinking about how you're going to do that. It's very clear in the regulations, in the new regulations, that you have to record each job separately. We have to have all individuals' separate job details coming through, because we have to have a separate record for each one as well. And I know that for, not all, but for some payrolls that was going to prove to be a bit of a problem as well. There was a bit of an anomaly last year as well, so any pay that was then paid after the 1st of April, but related to a period before the 31st of March, had to deduct contributions onto the 2008 scheme and then also exclude it from the pensionable pay for that year as well. So at year end we were needing that amount to be taken out so that we didn't then use that in the care pay. And you had to be able to calculate APP. We're going to have a little look at that in a moment. So that's assumed pensionable pay, and that was brand new for all of us. And I know, talking to people way back, that was the one thing that was going to start to cause one or two problems. The list goes on, doesn't it? You needed to then be able to deduct contributions for additional pension contributions, but also continue with any additional regular contributions onto the old scheme, and any existing added years contracts that were still in place as well. So, as I say, the introduction of the 50-50 section, and then payrolls had to be able to deduct half contribution rates, and then also have a facility to be able to put them back into the main scheme at any point in time, or if they were to get the trigger then on to re-enrollment as well. So again, it was just looking at how your payroll systems were going to be able to cope with that. And then be able to report those contributions separately also, and also to be able to give us totals of 50/50 contributions and APC contributions on a monthly basis, because we're having to hold them in the accounts separately to just main contributions as well. And as I've already said there, full-time equivalent pensionable pay under the 2008 rules is still needed for all leavers and at year end for anybody who's got service up to 31st of March 2014, because their pension benefits are still based on that pay. So I've just put a little bullet point there at the bottom. We did bombard you with information, we did invite you along to these sessions, and at the time we were trying to get the message across that you may actually need to look at resources within your payroll area. And I know feedback that I've had from some of the payroll people sitting here was, how on earth are we going to do all of this? You know, I haven't got the time, I've got my normal job, you know, that you form just a very small part of it, and we understood that, we accepted that, but we couldn't change the rules, unfortunately. That information was still needing to be provided, so it may have been that you needed to highlight to your finance managers, or if you are the finance managers, to actually start looking within your payroll function as to how they were going to provide all of this. But don't worry, keep calm and carry on. I think we need that pinned up on the wall, really, don't we? This is just a slide, again, just highlighting all the things that you do need to send through to us. So new starters coming into the scheme. We probably talk about new starters all the time, and for you, I would have thought probably a new starter is a new employee. For us, a new starter is anybody who starts paying into the pension scheme. So it's just to remember there that it might not be just telling us of a new employee, but also somebody who is an existing employee but then either opts into the scheme or they're brought in under auto-enrolment. Hours changes, we've continued to say send them to us. We do only need them for anybody who's protected who are protected by the underpin. So anybody who was close to retirement, we have to look at whether they're going to get better benefits under the new scheme to the old scheme. In order to do that, we needs to still be pro rata in their service. For payrolls to identify who those people are with protections is quite difficult, and I know from speaking to people, they've said it's difficult for them to identify it. So we've just said, send us everybody's hours changes through, we'll still accept them coming in. But if that causes problems, let me know, because we can try and identify who we really do need them for. Secondments, I'll just pop that one in there to mention as well. We treat secondments differently to somebody who might just be changing jobs or post numbers. So we do need to know if somebody's just being seconded. And then I think most of everything else up there on that list you're probably all familiar with, of the things that you need to be sending through. I'm going to talk a little bit more in detail about the monthly returns and what will happen, what has happened at year end and what we're hoping to happen at year end going forward as well. And the very last thing is just another reminder again about paying contributions on time. It's one thing that Pensions Regulator will be looking at, and it's just making sure that you get those contributions to us by the 19th of the month following deduction from pay. So we'll take a little bit of a look now at pay. That's pensionable pay under the 2013 regulations. That's the actual regulation that states what you must deduct contributions from. It's fairly straightforward now. I've just put in regulation 20.1, and basically it's just all salaries, fees, wages, overtime, additional hours. The exclusions are listed under regulation 20.2. I haven't listed all of those, but they're things such as travel, allowances and subsistence and payment in lieu of notice. So just to be sort of aware of those. So cumulative pensionable pay, and I've put in brackets there care, it's already been mentioned quite a few times today, but we do refer to pay under the new scheme as care and pay under the old scheme as FTE. So if we do go off talking in those terms, that's basically what we're meaning. So cumulative pensionable pay is the pay as defined in the regulations, and it could be for either section of the scheme, so the main or the 50/50. Again, I've put there reported separately. So it doesn't include any pay that relates to pay before the 1st of April, but it does include your assumed pensionable pay. We'll have a little look at calculating that in a moment. And again, I've put at the bottom there, I keep saying this, don't I, provided separately for each job. Assumed pensionable pay, I think that's probably what we all wanted to do when we started reading how you calculate assumed pensionable pay. I know I did. But unfortunately, we can't ignore it, we can't not calculate it. We've got to include assumed pensionable pay to ensure that somebody's pension benefits are correct. So it's needed it's needed for a member's pension account if they are on a reduced contractual pay or nil pay as a result of sickness, or if they're on any child-related leave, so maternity, paternity or adoption leave. It is also used if anybody's on reserve forces special leave. I'm not going to go into any detail about that. If you do get somebody who goes on reserve forces special leave, give us a call and we can talk through that because it's quite complicated.
Yeah, that just means we'll have to look at the guidance.
Yes, it does, yeah, that's absolutely right, yeah. We need to get the books out as well. So when it is calculated, the amount is then added to cumulative pensionable pay, and it should then be the APP and not the actual pay if any is received for that period. So as an example there, if somebody's gone on to half pay sick, once you've calculated what that assumed pensionable pay is going to be, that replaces the half pay sick for that period of time. There is an exception there. If you've got anybody who might have come in for a kit day, then that kit day might mean that their pensionable pay is actually greater than APP, so you would be using that in those circumstances. Employees and employers' contributions are deducted from it in the normal way. And then once set, assumed pensionable pay is not subsequently adjusted unless it continues for a period that then crosses to 31st of March dates. So it could be that you calculate it and you're using it, and then if a pay award or something comes along, it still stays set at that amount. So how is it calculated? So for a monthly paid employee, it's calculated by taking the average of three complete monthly pay periods before the APP applies, and then you gross up that average to an annual figure, and then you might need to add back in any lump sum payments if you think that there was a reasonable expectation that that's a regular payment and would have been paid during that APP period. For a weekly paid employee, it's the same principle, but you're using 12 weeks of pay rather than obviously 3 months. So we're going to have a little look at an example. Mr. Potter, very young Mr. Potter. we do age one in Shropshire, don't we? So he's received the following payments in his 3 months prior to the relevant event. So got month 1 there with 1,400. Month 2, he had a £1,000 bonus and £100 overtime. And then month 3 was back to 1,400 again. So when calculating that APP, we're going to take month 1's pay, but in month 2 we're going to take out that £1,000 bonus. It's not a regular payment, it's not something he's likely to get again. But we're going to keep in the overtime because he does get that, not necessarily every month, but he does get it. So we're going to add those 3 payments up, divide it by 3 and gross it up to an annual amount. So we get there an annual figure then of his APP of 17,200. Okay, so the left-hand column, there is the amount of pay that he received during that year. So as you can see there, July, August, September and October, he'd gone on to half pay and say he was off on sick leave. So that's why you had to calculate the APP in the first place, going back to those using the April, May and June pay. So you would take out the half pay and replace it with the assumed pensionable pay that you've calculated, so that you then report to us the pay at the bottom of £18,033.32 for that year, not what he'd actually had of the 15,100, because you had to put in that assumed pensionable pay because of him being off sick. So can you see there's obviously quite a difference there. If you were reporting the left-hand side figure to us, we're going to take that, we're going to go on then and calculate his benefits, and it wouldn't be right. So what I've done there is just throw in some figures so that you can see how we then take that pay. So in the top table, year one, we've got pensionable pay there of that 15,100. We divide it by 49, so we'd give him a pension of £308.16. That's then revalued at the end of year one. Year two comes along, he's fit and healthy in year two, he wasn't off sick again, so he had his full pensionable pay of 18,500, a 49th of that, revalued at the end of the year and added into year one. So there we've got a total pension build-up of 692.57. The bottom table is doing exactly the same thing, but in year one we're putting in the correct pay, the one including the APP. We revalue it, we drop in year two, we revalue that, and we add them both together. So you can see there that there was a difference of £60.47 on that person's benefit. So if we hadn't have had that APP included, he would have been less £60.47 of his pension. So that's just sort of hopefully reflecting there why it is really important that we're not burying our head in the sands when it comes to APP, and that we are calculating it and that you are then reporting it back to us. So that's pretty much covered very much, you know, a whistle-stop tour with a bit on care pay. If we move then now to full-time equivalent pensionable pay, so the FTE pay that is required still for anybody with benefits up to the 31st of March 2014, but calculated under the 2008 scheme regulations. So it's needed there, obviously, it's just sort of saying anybody who's got those protections in place, and you must be able to calculate it for all leavers and also for figures at year end, because we do use those on the annual benefit statements, and as Helen's already touched on as well, for calculating assessing tax allowances. So calculating the full-time equivalent pay, it's the pay that somebody's earned in the previous 12 months. So obviously that's as at date of leaving or as at year end, so 31st of March at year end. So for next year, you'll need to be giving us from the 1st of April to the 31st of March 2016. It's then grossed up to the full-time value for anybody who's part-time, and it doesn't include any non-contractual overtime or additional hours. So that's where the big difference is between the two definitions of pay. And APP doesn't apply under the old scheme rules. So for anybody who was off on sick leave, you're looking at the notional pay, easier method, how we used to do it under the old scheme rules. So we'll have another look at an example. Mr. Weasley this time. So he's a full-time planning officer. So his salary details in 2014-15 were as follows. So he was on a salary of 21,000, which increased to 21,500 on the 1st of January. And he had during the year £500 non-contractual overtime. So it's quite straightforward. 1st of April to 31st of December, so he had 9 months at the £21,000 rate, and then 3 months at £21,500, giving him a total full-time equivalent pensionable pay for that year, £21,125. The £500 overtime you don't include because it's non-contractual and therefore doesn't form part of those regulations. And another example, we've got a bit of a theme going on here, haven't we? She really is aging well. So Ms. Granger, part-time library assistant. So her salary was £10,500, which increased to £10,750 on the 1st of January. She receives £50 a month for Saturday working, which was contractual. So again, same periods of time, so we've got 9/12 of 10.5, 3/12 of 10,750, and then the total of those two, you need to then gross up to the full-time equivalent value. So that would then give a full-time equivalent salary of £21,125. You then have to add in her £50 a month for a Saturday working, because that is contractual, so that's included. She would have paid contributions on those under the old scheme rules. So 12 of those, adding in £600, giving her total figure there at the bottom. You wouldn't add that in before you gross it up to a full-time value. You would add that in afterwards, because there's only one Saturday in a week. You can't make that a full annual figure. So you would add that back in afterwards. Okay, so any questions on any of that? So why is providing pay so important? Well, we'd already looked at the one example with the care pay on how it could go wrong. And I think the second bullet point there is probably quite, sort of blatant. If the pay figure is wrong, the pension will be wrong. It's not many times we really say, if it's wrong, but in this case, it really is that. Full-time equivalent pension pay, as we've already mentioned, will then be used for estimation of benefits on annual benefit statements. And also, I think importantly, touching on what John had been talking about this morning with valuation, those figures will be going to the actuary next year, and they will be used in their assessment of what the benefits are going to be. So again, to make sure that all your data is accurate and your employer contribution rate is accurate, we need that pay figure accurate. So how are you providing us this data? I think a lot of you are familiar with the monthly returns. We introduced them last year when the new scheme came in. We were hearing and being told that we needed to be updating employees' records with care figures on a monthly basis. We want to be feeding them through to our member self-service so that individuals themselves can go in and look at their pension account building up. So monthly returns were introduced. We've also started looking at a system called iConnect, and we're working with Telford and Wrekin Council and Shropshire Council on getting that up and running. And that is a more secure and electronic way of transferring data from payroll system directly through to pension system. We had year-end returns in 2015. Again, I've just put a note there, obviously full-time equivalent pay is needed at year-end. We're going to have a little look at some of the feedback on that. But our main aim has been improving data transfer from employers to pension system and reducing the use of paper forms. I think we all want to get rid of paper form filling, and that's been one of our big key things on trying to reduce that. So year-end 2015, how did it go? I can honestly say it was probably one of the hardest year ends we've ever had in the pensions team, and I've been doing it a long time now. We had a deadline set of the 13th of April, and 38% of employers were able to send their return in by that deadline of the 13th of April. The further 60% were then received during May. Quite a lot of those were within that first week, to be fair, so some only just missed that deadline, and 2% were then received in June and July. Just one employer struggled to send a return for current data to be included on annual benefit statements. We've been working with them. So we'd sent out a spreadsheet to all of you with a template. We tried to make it look very similar to the monthly return. We added in some columns to allow for the fact that people might have changed their employee contribution rate during the year. So we might be having to take information for 3 or 4 different rates. And then for those of you who don't have a large number of employees, we did adapt a slightly smaller version of that one, and those were then manually updated into the system rather than loaded electronically. So some of the issues that we encountered this year were the fact that APP wasn't included in pay. We had some instances where pay that was paid in April that related to the previous year had been included, so we had to take that out. We had some returns where full-time equivalent pension pay wasn't provided at all or wasn't accurate for the year. We've had some instances where contributions that have actually been received during the year, so we've got an amount sitting in our accounts, didn't then agree with the totals on the year-end return. 1 or 2 issues around sort of formatting on spreadsheets, which we overcome quite quickly, but because we have to take the data from the spreadsheet and load it directly into the system, we had 1 or 2 issues around that, and also missing records where we may not have been told about new starters during the year. So we worked with employers individually to resolve those particular problem areas. Some instances that might have meant that we had to have a revised return from you, or we've had to have revised pay, which we've then loaded in where necessary. But we were really pleased to say that we successfully sent our annual benefit statements out before the deadline of the 31st of August. Hooray there. We were very proud that we were able to do that. We know nationally that there were a lot of other problems as well, and some funds didn't get annual benefit statements out in time, but we did. It was hard work, but we got there, so we were really proud of that. So I just wanted to just go over finally where we're going forward with all of this. So we're continuing to work with employers to ensure that the monthly returns are being used. And I am getting good feedback from people. I've been chatting to one or two at lunchtime, and you know, they're seeing some real benefits from using the monthly return. And for those of them that are doing that, it does mean that they've cut out on lots of different ways of telling us of new starters, lots of other spreadsheets. It's all now been able to come in on one. We're working there very closely with Shropshire Council and Telford and Wrekin payrolls to go live with iConnect. That's been we've spent a lot of time, put a lot of time and resources into that over the summer to get a good working extract so that they can get their information out of their payrolls and send it directly through. And we have successfully gone live with 10 employers who are employers who contract their payroll services to one of our large authorities, and we're on the second month now with those, and again that's going really well, and we're going live with the main authority next month and the remainder of their 3 employers, and then we're hoping to get our other large authority live with some of their employers next month as well. So it is going good. Because we're successfully moving along with iConnect and we've been doing really well with monthly returns, as long as all the data continues to stay as we need it, so depending on what comes out from what Helen's talking about with annual allowance, I'm going to put my neck on the line now and say that we are hoping we're not going to need year-end returns in the way that we've had them in the past. Your month 12 monthly return should really have everything on there that we need for the year. We've added the column at the end, which I think is headed up in bright red, which says needed at month 12, which is the full-time equivalent pensionable pay column. So as long as we've got everything on there, and we're happy that we've got all the data into the system, we're hoping that we don't then need a year-end return as well, because you'll probably feel it's duplicating work, and we feel it's duplicating work, and obviously that's something we're trying to avoid. So we would want that month 12 return as quickly into April as we can get it. Most of you are sending it because it forms part of a remittance advice with your payment, so we're getting them all by the 19th of the month. So all being well, in April, on the 19th of April, everybody's year end will be in and done. Debbie's laughing. But you know, that's really what we're aiming for. If that actually works in practice, we'll yet to see. We would still need a sign-off reconciliation form so that we can have a look at totals received to your monthly returns and also to what's going into iConnect. But that is what we're working towards, and I really hope that does work as well for all of us. Fingers crossed.
This actually ties back with your ISA 19 or FRS 17 statements that John was talking about earlier as well, because we have had instances where the number of employees that may be captured on that information varies a lot between one year to the next, and when we've had queries back, it's because at year end in one particular year we found out that actually from the year end postings that employer hasn't kept us up to date with giving us the new starters through the year. We've captured them at our year end process, but of course because that's going into June, July, that's after the FRS 17 statement has been produced for people, and so the following years has all of a sudden caught up. So the monthly returns now we're hoping will feed into more things than just the year end, because it's ensuring your data is better for your FRS 17 statements. And as John said, for your accounts apparently, for anybody with the 31st of March, that's becoming and being drawn even earlier for you. So hopefully, just with us working with your teams to try and get this done, it ensures beyond the valuation data, your actual financial data is right for your accounts too.
So that's really it from me. Pleased to know, I'm sure. Just a little bit of a few pointers really on where you can get further guidance. We've mentioned before, have a read of the administration strategy, which is on our website in the employer area. Our website address is up there. That's my email address and also the generic pensions email address. So if there's any questions, obviously if you go away and think about anything, or you'd like more information on iConnect, or you're struggling with monthly returns, or there's something you don't like about them, drop me an email and then we can have a look at that. So that's it from me. If there's any